All right, here we go. Oh my God, I can't embed them fast enough.
Go on mute, Alexis.
Oh, sorry.
Thank you all for joining. As we begin, we're going to wait a couple minutes and let folks continue to join on. We'll probably start a couple minutes after 5:30. So hang tight, and thanks all for being here. I liked the fireplace better, Reilly. There we go.
It's very hot in here, Kyle. I don't know how to turn these things off. I should have brought some. I have a little marshmallow on a skewer. I just kind of, does this work? And I just,
Next time.
It's one of those fireside chats.
Oh, whipping up. This is Callie with the Roosevelt reference. Well done. A minus, Callie. Very good. She graduated. You grade people arbitrarily. The best part about being a faculty member. Ooh. Can I have co-host capabilities for my PowerPoint presentation? I won't put it up immediately. I'll keep it on the down low.
Kyle, can you do that or should I do it?
I think you have to since it's the white.
Okay, hold on.
For those of us that are just joining, we're going to start here in a couple minutes, so hang tight. Thanks for being here.
Hey, Reilly, can you give me a host back for a second? Thank you.
Of course.
Alexis, if you want to keep it until, as you're continuing to admit people, you can give it to Reilly right for the presentation.
Yeah, it doesn't look like we can both be hosts.
Alrighty, well, we're going to go ahead and get started, everyone. Thanks for being here today. My name is Kyle Biederwolf, and I'm the Professional Development Chair for the Young Professionals of Albuquerque. We have a very exciting event today with a very exciting speaker who has some lasers behind him right now. But we have a couple of housekeeping items first. If you look in your top left corner, we are recording this video. So please turn your video off now if you do not want to be recorded. We would highly encourage folks to be on camera throughout the event so we can interact with each other and ask questions. But if you wouldn't like to be recorded, please turn your video off now. And to ensure that everyone that is in this meeting has a voice in the room, I would encourage each and every one of you to go to the chat feature right now and say who you are and what you do, where you work. Usually we're all in a big room together and we get to network before, so we can do a little networking in the chat now. And as you've heard hundreds of times now, please mute yourselves throughout the entire event. We have a larger group tonight, and we really want to be respectful of our speaker, Reilly White. We will have time at the end of the event for Q&A, but if you have questions during the event, I would encourage you to put them in the chat, and Reilly has said that he is going to rapid fire answer the questions that you put in the chat. But those that he can't get to, we'll have time at the end for Q&A. There's our first non-muter. Make sure to everybody to stay on mute. And again, since there's so many people here today, I would encourage you to edit your gallery view mode to speaker mode so we can all focus on the speaker once he starts. This can be done at the top right corner of your screen. If this is your first YPA event, I would encourage you to check us out. We host events like this, monthly lunch with leaders, and other events, including networking, all of the time. So please reach out to myself or any of the board members if you have any questions about the organization. I would also encourage you to share your experience on social media tonight. Tag YPA and Reilly White on LinkedIn, and tag YPA on Facebook and Instagram if you do post anything. And last, as always, I want to give a big special shout out to our annual sponsor, Nusenda, for supporting us to make sure that we can continue to have events like this. And now for our event. The Young Professionals of Albuquerque and the CFA Society of New Mexico have had a multi-year partnership to bring events like this to young professionals all across Albuquerque. Our last two events have focused primarily on financial literacy, but tonight we have a very special topic from a special speaker. Dr. Reilly White is an associate professor of finance, Endowed Bank of America lecturer, and Daniels Fund Ethics fellow at the University of New Mexico. In addition to teaching MBA students, Dr. White serves as the University Outreach Chair for the CFA Society of New Mexico, advisor for the $4.5 million student-run UNM Regent portfolio, and leads a series of financial literacy projects in the community. Prior to his career in academia, Dr. White worked as an analyst for a large Boston-based bank, say that 3 times quick, Boston-based bank, where he learned a great deal about company analysis, funding, and maintaining ethical corporate leadership. He also consults with investment managers and municipalities on maintaining optimal portfolio strategies, particularly in response to economic challenges. So if there's anybody in the world that we could get on here and try to explain Dogecoin to us, it sounds like Reilly has the resume for that. I've had the opportunity to work professionally with Dr. White, and I know that there's many MBA students on this call that have taken his classes. I can confidently say for all of us that Reilly is one of the best folks to work with. And without further ado, I present to you the event that Reilly came up with the name, Chomping at the Bitcoin. Is this jesting or investing? Take it away, Reilly.
It's all going to be bad puns from here on out. And I want to say thank you, everybody in this room, for coming here on this a Thursday evening. You have so many things to do. You have opportunity costs, and you've chosen to spend it with me and this fantastic group of people. I'm so grateful for your time. I'm so grateful that you are here. And I have such familiar faces here. I have ex-students. I have professionals who I've known from the workplace. And I have people I don't know yet, but also people I'd like to know. And also I have people back from my high school days. I have family members and relations. I couldn't be more excited about this audience. And those of you as well, I want to thank Young Professionals of Albuquerque for allowing us this juncture today. It's a fantastic organization for networking, especially for those in the under 40 crowd. It is a great spot to begin and grow your career with an outstanding group of individuals overall. And thank you, Kyle, for letting me come across here and do this thing. I am so incredibly grateful. Now, also in this endeavor, I want to thank the CFA Society of New Mexico, Sonny Gokle, our incredible president at the CFA Society of New Mexico. I'm a board member on there, but so is Callie, also on board here. They're fantastic. As an organization, when we think about finance and we think about setting things from fiduciary responsibility to ethical standards, the CFA organization is where it's at. You don't have to be a CFA to be a member, and it's a thing for you to consider, especially down the line. So I want to say thank you so much. And also thank you all again for being here tonight. I went to high school with Greg. Greg, I'm so glad you're here. All right, so one thing, let's turn this up a little bit. And is it possible for me to share my screen? I don't know if you can make me a co-host or an anti-host. I don't know what works best, or regular host. I have no other options to share.
You should have an option now, Reilly.
Oh, I have an option now. Okay, let's take a look. I do not. Uh-oh. Hold on. So I made this presentation. I was very excited to give this presentation, and I still am, but it's a question. It's such a vast topic, and we have to sort of marry these different principles between it. I actually don't see it. I'm so sorry.
Hey, Reilly, if you want to email me the deck real quick, I can drive for you.
Oh, there it is. I got it. You're right. It works. I was blinded by the finance. All right, so here's what we got. Let's start this slideshow here. And again, I want to appreciate it. Thank you so much. I appreciate everybody in here. Oh, we have a whole bunch of great people in here from a diverse series of options. And we're going to come across today knowing fully. I've got people in here that are epic crypto experts. They've been investing in this for years. I've got people who have no idea what's on the news about this, and they're just looking for understanding. And on the other hand of this, I've got people somewhere in between. I see these things. You may have invested in this. Where's the value? How do I do this? How do we make things work? And that's what we're going to discuss in here. So as I said, as Kyle brought up, I'm super excited about this. You've got questions, put them in this chat and we're going to rock and roll. Can you guys see the screen okay? How does it seem? Does it seem okay? Can you reach out and touch it? Cool. Okay. If there's an issue with screen sharing or anything else, just pop me a question. You can also direct message me personally if you have a question and you're like, oh, I don't know if I feel comfortable having my name quoted or anything. I will keep you anonymous and you can use the chat window to your best benefit. So anyway, here's what we got. Chomping at the Bitcoin. Is this jesting or investing? And that's me, Reilly White. I'm an associate professor of finance. It means I get to associate with professors at University of New Mexico. Now over here, why are we here? What are these coins about? What's happening? What are we doing? And a lot of this happened this way, and this will be fun because I know in my audience, I have financial professionals. And I know also in the audience, I have people who are technology experts. And we have all of these different points of view. Technology experts will say, this is the future of this and this. The finance experts gets frustrated because they see this and all they hear from their clients are like, well, I understand you've given me a 40% return this year, but my great nephew gave me an 18,000% return by investing in Dogecoin. Why can't you do that? So it's frustrating for finance folk. And my goal here is to operate in this intermediate space to bring both of these things back together. Cool. Sometimes I'm getting, all right, cool. And I will. So thank you so much. I appreciate being host. So as you know, Stephen Colbert came out and said, this is gold for nerds. Might be, might not be. But what is it? So let's think about this for a second. This is the element of cryptocurrency that has struck the most chords with how people have operated. Now imagine, let's go back in time to 1 year ago. And let's say on May 1st of 2020, you were given $10,000 to invest until May 7th of 2021. I picked May 7th because that was the peak of our cryptocurrency. Still up there. It could go back again, but that was the highest values. Now, again, if you put that money into the S&P 500, which is the 500 largest stocks across the United States, and you put those stocks into, and they're combined in a portfolio, it's valuated, and what you would have after a year, if you invested those dividends and reinvested them, is about $15,000. Now, that 52% return is huge by all standards. If we go back about 100 years, the market usually averages about 10 or 11%, depending on if you use the arithmetic or geometric averages. So this year has been an incredible year for stocks in this portfolio. Now, if you had taken that 10 grand and put this in Bitcoin, you'd have about $65,000. Okay, you're like, that's impressive. If you put it in Ethereum, you'd have about $163,000. And then this is the most incredibly disappointing of them all. If you put this into Dogecoin, you would have had $2,745,000. That is almost enough to competitively purchase real estate in this market right now and not be outbid. This is an amazing sum of money. So this is, so of course, and this is the reactions we'll have, right? So we look at this and we say, this is a bubble. We look at this and we say, and of course, this isn't a real financial asset, it's speculation. Why are we even discussing this in the context of something in finance? But I know that everyone who's client-facing in finance has to deal with questions around these issues. And everyone who's been doing this for years, this doesn't come as a surprise. And they were looking at this run-up as a fundamental aspect of how people have come online with regards to the marketplace. Now, in reality, both of you are correct. The side of you that says, oh man, this is not really what it is, it's not valuable, it's a bubble, yes. And the other side of you that says this is a promising, the crypto evangelist side, this is a promising future for how things work. So I want you to keep in mind these things. And we're going to try to cut a path down the middle here, where we recognize the value of blockchain, but also the speculative nature of some of its component parts. And I want you to ask questions, ask me anything in here in the window. I'll do my best to answer them as we go through it. And to give you a sense of this needs a visual. We need a visual here to make this work. And so we've got, and this is usually, so, I mean, if the market goes up 50%, it usually looks impressive. This is the S&P 500 return. It's like a flat plane. It's like suddenly we're in Clovis. And then I go up a little bit and now it's Bitcoin. Oh, look at Bitcoin. Nice. It's a nice little hillock. It's like, oh, it's somewhere in East Mountain. Now we go to Ethereum. The return over the last year, it looks incredible. Look at that peak it reached in early May. And then Dogecoin, just for kicks. I could not fit this on this. This actually extends 10 slides upward. So to answer the first question, where is the moon? The moon is up there in that sense. Yes, it is an orbiting body 250,000 miles away, but it is still something that is very close to this. It is astounding the growth that we've seen in this category. And the reason people look at this as being speculative is for things like Elon Musk, right? Elon Musk, founder of Tesla, founder of space initiatives around the world. He tweets one word, Doge, on December 20th, 2020. What happened to the price of Dogecoin? It shot up 15%. Every time I tweet something, nothing happens. I don't understand it. Now, likewise, how Elon Musk changed his Twitter bio to hashtag Bitcoin, we kind of see the same thing happen. And in this situation, a mere question, a mere aspect of him mentioning and putting hashtag Bitcoin on this shows you, whoops, shows you how astounding the effect was. Bitcoin rose in price by $4,000. So I want to think about this, and I want you to look at this, and I want you to consider what's going on here. We have a new asset class. We have a series of technological progressions that have happened in a way that have sort of taken the market, that's taken this particular market by force, but also one that's prone to huge volatility. And I'll explain a little bit about why that is. So what we're going to do today, and in this presentation, my side thing is now we're cooking with crypto. We are cooking with crypto tonight, and here's tonight's plan. I'm going to go over a little bit of the blockchain basics. Now, again, I'm coming from this from the finance side, and so I know I've got my incredibly technically capable and cognizant audience out there ready to rock and roll. We're going to go over the current digital phenomenon. We're going to drop some info about NFTs, non-fungible tokens. Non-fungible tokens. And this is an interesting part because this actually does, I mean, it actually possesses a very interesting economic value. And then we're going to talk about the case for value, how to value blockchains, decentralized finance and the future of cryptocurrencies. And then I want to talk a little bit about some big takeaways here. Speculation versus investment. What are we going to do about it and how do we take it from here? So let's go back in time to a distant and faraway period. Back into the ancient period of time known as 2008. Many of you don't remember this time, but we had dinosaurs and various things, and our cell phones were much smaller. But the person and this is really interesting, a person or people, because we actually don't know for sure the identity of this person. Most likely it's a group of highly technically capable individuals. Together, they were known as Satoshi Nakamoto. They published a white paper called Bitcoin, a peer-to-peer electronic cash system. And what this did, this paper laid out some of the important principles of a very new way to transact online. So let's do this. So first, what was so novel about this? And again, it was 2008. At that point, I was working for a bank and trying to not catch everything. Everything was on fire. I was trying to apply to a graduate program. The graduate program was on fire. I'm just trying to get rock and roll there. And anyway, this was happening. And it was almost like, oh, I don't recollect it. It became instrumental for what it started among highly technical circles in the forthcoming years. But it basically proposed something that's very, very intriguing. Anonymous, decentralized transactions without the need for a third party. The ability for people to exchange things, currency, information, data, contracts without the use of an intermediate party. Why is that so significant? Because that cuts out the middleman, and the middleman charges you money. Now, Bitcoin is a unit of value that they created that you can use to pay for these transactions. And interesting about Bitcoin, it has no central intermediary. Back, if you think about where we are in the history of finance, back in 1944, with about 1 year left in World War II, we established something called the Bretton Woods system. And the Bretton Woods system, named for a hotel in northern New Hampshire, was named for an economic system that came to be by setting sort of the post-war rules around the economy. In this economy, the US dollar was transferable into gold, but no other currency was. Other currencies had to go through the dollar to get gold. And we had effectively a gold standard until it fell apart in the 1970s. Since the 1970s, we've had 50 years of free-floating currencies, but most countries possess some form of a central bank. And that central bank operates in a way where they help control and supply of the currency in the marketplace. And Bitcoin proposed something which is without a central intermediary. There's no central Bitcoin bank to decide these things. And then you ask yourself, well, okay, so how does this work? Is this secure? They developed encryption. And we'll talk a little bit about encryption in a little while too, because I know encryption is something given as both the advantage and potentially an Achilles heel for people looking ahead at solving cryptographic puzzles and looking at the future of computing. It might be a problem. But proof of work, which is basically the idea that computers can perform a task that helps encourage honesty and build security, and we'll talk about that. These transactions collectively make up things called blocks, and these blocks make up a blockchain, all of which you can visibly see. And really, we think about this, and I've been writing papers about this for a few years now, and we studied it as a financial asset and a currency. Bitcoin doesn't move like currencies. It's an electronic asset, as well as a digital currency. It's a network of computers, keeps track of these Bitcoin payments and adds them to an ever-growing list of all the Bitcoin payments that have ever been made. It is an open ledger, but each of the addresses behind the ledger is anonymous. And that's what's very, very interesting about this. Collectively, we call it the Bitcoin blockchain. And some other keywords here. The file that contains all the data in a Bitcoin transaction, we call that the ledger. And Bitcoin values are created through something called transaction processing, known as mining. We'll talk about that in a little bit. And individual computers become nodes. And so take a look at this. You've seen graphs like this everywhere. In fact, I actually looked at this graph to correctly source this graph, and these graphs are identically presented across hundreds of different websites. But this one particularly, I don't know if they originated it or not. It's going to be its own little scopes, find the truth for who made this graph. This is made by Block Geeks or utilized by Block Geeks, another informal association of cryptocurrency people. So in essence, to walk you through this process, when you enter into a cryptocurrency transaction, someone requests a transaction. And the transaction could be a buying and selling something. It could be exchanging a non-fungible token. It could be something like medical records or contacts or information. And the requested transaction is broadcast to an entire peer-to-peer network with individual computers operating as these nodes. And these nodes collectively validate the transaction. Not a central bank, not somebody going, yep, that's the right transaction stamp. These computers do it. And once this transaction is verified, the transaction is combined with other transactions to create a new block of data. And in Bitcoin, what it does, you add up all the transactions till it equals 1 megabyte. And this becomes a block. And that block goes on to another block and to another block, and you have a chain of these blocks. And each of those blocks is composed of transactions that have been verified by all these external computers. The new block is added to the blockchain, and it's permanent and unalterable. I can't go back and delete this. And then the transaction is complete. And a verified transaction on that right-hand side could involve cryptocurrency. It could be contracts, records, or other information. Now, cryptocurrency has no intrinsic value in the sense that it's not redeemable for another commodity, but it does not make it valueless, which I will point out. There has no physical form. Like I can't go out and collect my Bitcoins. I can't have rolls of Bitcoins in my pockets and just pass them around. And then its supply is not determined by a central bank. It's completely decentralized. And so that's what makes this very, very interesting. What an experiment it is, right? And so there it is. So the problem with coins, when we talk about coins and transactions, we've got all kinds of different ways to look at this. And I have to post this because it's so amusing to me. So to pay for transactions, cryptocurrency can come in either token or coin forms. And I'll go into what these mean. Coins are ways you pay for these transactions that have their own native blockchain. So the Bitcoin transactions have their own blockchain. Tokens, on the other hand, are built onto another blockchain. So for instance, Ethereum, the Ethereum blockchain uses Ether. People can buy and sell things using Ether. We'll use an example of this using NFTs coming up. Tokens, on the other hand, use the Ethereum blockchain, and they have names like Augur, Golem, and Aragon. And as you know, the deep-seated nerd in me finds this so amusing. But the reality is each of these tokens, even though they might operate the same under the same blockchain, it's not equivalent to like ADRs in finance or anything. It's not going to be trading at an equivalent level. Demand for Augur is going to guide the price for Augur. Demand for Ethereum will guide the price to Ethereum. And even though they might be using the same blockchain, these tokens trade in different ways. And so that's the practical thing behind it. Now the value, and this is the key part here. Look at these things. And on the right-hand side, you might know these symbols. You might have seen them before. On the top right, that's Bitcoin. That's the symbol for Bitcoin. Below that is the symbol for Dogecoin. Itself, kind of a mockery of what Bitcoin was, but also, again, not without value, as I'll point out. And then on the bottom, we have Shiba, which is another coin derived to be itself a mockery of Dogecoin. And so we could just keep going down this ladder until we derive the most absolute Canada-based coin, which comes in its most fundamental form. And these can be operated for transactions. Now, when we think about value, I want to step back for a second and think about what do I mean by value? So there's a fundamental value to something, and there's something we call a hedonic value, and I'll get into that. The fundamental value is how we operate most of the time in finance. We go out and we find an equity or a stock. I'm sorry, equity or stock. Equity for a stock, for instance, for those of you. We want to buy a stock that we really like. We might perform something like a fundamental analysis. We might look at the cash flows for the future. Finance, the F in finance is really about future. It's about forecasting what will happen 1 year, 2 years, 3 years, 5 years down the line. Now, the fundamental value of something is based off of their future cash flows. If we think a stock has a very promising future cash flow stream and the market's undervaluing it, it might be a good buy. And we look at something like Bitcoin and Dogecoin or Shiba, and we look at these things, we're like, how does that even work? So the short answer is a fundamental value. If you approach something like Ethereum or Bitcoin, the two most widely used cryptocurrencies, if you believe they would, say, become a dominant force in transactions, that's a fundamental form of analysis you can make. If they were widely used, widely accepted, you could value them. Now, some coins don't promise that at all. Some coins don't even try to pretend, right? If you're Dogecoin, you're not saying they're saying you really think everything's going to be Dogecoin. So why do people buy Dogecoin? And the answer is you buy it for its hedonic value. Now, hedonic value refers to buying things, and think of the word hedonic. It sounds like hedonism, right? It's like, but it's really about buying things for the emotion that it brings you. So think for a second in your houses. And let's say something terrible, let's say there was a fire, but all your family and your pets and your children were safe. What would you take out of your house? You take out something that probably held emotional value to you. Old pictures, perhaps, maybe collectible items. These things collectively become something that becomes incredibly important in the way that we value these things. So things can have hedonic value. You might say, you might have a collection of baseball cards, and that baseball cards, because you might enjoy baseball, has hedonic value, and maybe it also has fundamental value because maybe these cards are rare and they're appreciating, and you can make a gauge as to how rare they'll be and how well the market will look for these in the future. And Dogecoin is a thing because people like to buy it, because in itself, it represents sort of a cultural artifact from 2020 and 2021. It is something based off of memes, which people find adorable and hilarious and fun, and they buy it for that purpose of owning that fun, that thing that brings them joy. We do that a lot. We make a lot of purchasing decisions based on hedonic value. And that sense, in the sense that Dogecoin is something that you can buy that is representative of that value, becomes really, really important. But it's also limited. And as we know, that if we were to do something like you could pass down as part of your estate, let's say, holdings and equities in certain things, right? And you know that IBM back in the 70s is going to be worth whatever IBM in 2020 was, and IBM in the future is going to be worth whatever IBM is going to be worth. It's unlikely. Hedonic value doesn't really work the same way. In the same way that you inherit something that might not have the same value as your parents or grandparents valued it. Hedonic value can diminish with time. It's hard to transfer. It also results in a lot of bubbles, right? Think of the Beanie Baby explosion, 1998. That's another, it's an ancient period of time from long ago. In that period, people bid up the price for an incredibly inexpensive imported toy known as a Beanie Baby to levels that were unheard of because of hedonic value. They liked the emotion that it caused was positive, but then there was also competition. There was also bubbles. I would argue that hedonic valuations produce a lot of bubbles. Certainly, if we go back to the Netherlands in the 1640s, when there was the tulip mania, 1630s and 40s, I should say, 1636, 1637, tulip mania happened. People demanded incredible prices for tulips, and there probably is a fair price for a tulip, even in the 1630s. But it was a bubble that went up and it crashed. And so it's possible that these things are, but it doesn't mean they are valueless. What do you have questions about this so far? What do we got? Anyone have anything they want to bring up at this juncture? Okay. People are already asleep. They're like, oh, Reilly White. Too much Reilly, too little time. Well, if you got questions, just send them into the chat window and I'll do my best to get back to you as soon as I can. Cool. Okay. All right. I'm still going with the puns. I got like 10 more. This is going to be good. Winning hearts and minds. So anyway, when you think about cryptocurrency, there's a dimension of this, which is on the news quite a bit. And it was in the news this week because Iran made cryptocurrency mining or Bitcoin mining specifically illegal because of its power usage. The puns are half the fun. Thanks, Laura. Thank you, Laura. At the center of some cryptocurrencies, and I mean especially Bitcoin and Ethereum, not all of them, you can actually go out and mine them. In mining, you're like, oh, I got it's 16 tons, and you go and it's not one of those situations. Mining works a little bit like this. You have to build a rig. In this case, and I want to, this is great, and you have to put like 6 graphic cards together attached to a motherboard, and you put it in the computer system. And connect it into the network. And in a case like Bitcoin, you use a proof of work system. The miner has to solve a numeric problem by sort of an extended game of guess and check using an incredibly complex number. Miners who have higher hash rates indicate the computing power that you have higher odds of solving the equation. And the interesting part is, why would you want to, if you solve the equation, you're rewarded with Bitcoin. The block is verified and Bitcoin is your reward, which then becomes sold or traded. So there's a monetary incentive for mining. And we think of mining, these little rigs, people have tried to put huge amounts of capital investment in these things. This is an old picture, but this is one from back in a couple years back. This is we think of this like buried Siberian facility where there's a person under there going with 1,000 of these machines mining Bitcoin constantly and collectively using an incredible amount of energy. And you think about this, you're like, oh, mining, it seems like something, I pay for this rig. Is this affordable? Is this something that makes money? And indeed, initially, way back in the far back times, when Bitcoin came around in 2008, afterwards, 2009, 2010, when Ethereum came around, mining was profitable. But we actually studied this. And this is a model by an incredibly talented former student and colleague and co-author, Sterling Olson, where we actually looked at the question of, is something like Ethereum profitable? Is something like mining Ethereum profitable? And it's, for a little bit, it's profitable. But the problem is, it's not organically sustainable, meaning that because what happens when you mine something? If there's a lot of attention on mines themselves, or a lot of attention on a particular cryptocurrency, I should say, that increases, that means a lot of people are going to mine it. And if a lot of people mine it, the hash rate that's in the system goes up substantially. And when this happens, it means the individual odds of you actually winning that block go down. And so what happens, a lot of miners form these things called pools. And these pools can take up, say, half of the computing power at any given time for something like Bitcoin or Ethereum. And what they do is then when the block is won, they split the proceeds based on the computing power of each representative pool. Ooh, I have a question here, private question. If there's no fundamental value underlying the asset, how does investing in cryptocurrency differ from investing in tulips? That's a good question. And that's actually the fundamental question of this exercise is, how is this different than tulips? Is this different than other things? So tulips have a value. We know that there's a fair value for tulips because, and maybe it's purely hedonic. Maybe people just like looking at them. But there's also a fundamental value in the sense that, as we're going to find out later in this lecture, blockchains have very useful properties to them. Understanding and analyzing them, knowing that what they're doing, what's happening, this is all going to help us understand this. So to give you a sense of this, only 21 million Bitcoins are going to be mined by 2140. 18.5 million are currently circulating. And it used to be in 2009 that if you mined one of these blocks, you'd get 50 Bitcoins. Think about that reward, right? That's about $2.5 million today. And now the reward is just 6.25, and it diminishes. They cut it in half every couple of years. And the problem is there's so many people mining it that this reward gets divvied up into incredibly small sums, and it's not sustainable. So meanwhile, the amount of hash required to solve a block has gone up considerably, which forces a lot of miners to form pools to split the block winnings. And so people can make money in two ways from cryptocurrency. They can mine it for a reward, or they can speculate on the currency underlying it in transaction value. And those are the two ways we look at it. Now, we've seen something happen. My way or what are we dealing with right now? Is this the buy way or the highway to sell? And let's take a look. So we had a couple things that we have to put this particular bubble into context. Over the last year, we had an unprecedented economic shock, right? We had the greatest unemployment shock since the Great Depression. In response, the US government initiated a total of $5 trillion in stimulus packages over 3 different stimuluses, including millions of direct checks to American households. This greased the wheels of a lot of crypto boomers. So the question is this a bubble? That's what everyone else says. Is it a bubble, Reilly? You said it was a bubble a year ago. You said it was a bubble 3 months ago, and it's still gone up. Probably. But I'm going to quote my finance colleague, Campbell Harvey. And those of you finance nerds in the audience, Campbell Harvey's dissertation in the 80s was the dissertation that said, and it sounds so common sense now, an inverted yield curve predicts a recession. That's what Cam Harvey brought to the table. Cam Harvey still brings it to the table. Bubbles can be short or long lasting. And this is very important. There's nothing to say that the bubble will collapse tomorrow or in a year or in a year and a half. But it does make it risky and it does make it dangerous. And I like to think of this era as, remember back in the 1990s, right? We're flooded with a concept of something that everybody knew in aggregate was going to be so important, the internet. People were like, internet, yes. What is the internet? I am not sure. We all logged on with our 14.4 modems, and we all took off our phone space. I know people are like, what decade are you from, right? And we entered the internet. And remember the old internet? I used to log on to the University of Minnesota Gopher system when I was a boy. And it was fascinating to me how the internet worked. But no one really understood the promise of a technology and the realization of what represents those things. Amazon was around in the late 90s. It was founded in the late 90s. And Amazon ended up being a fantastic long-term buy. But so were two firms that failed. Pets.com and a company called Flues. You guys don't remember Flues, but Flues was also a really big company that attracted a lot of attention. Both these companies went bankrupt because the way that they saw the internet and the promise of the internet did not result in a reality. And you had companies like Priceline that were founded, went up a lot, dropped to tiny levels because people thought it was worthless, and then they still survived. Ooh, I got a question from Kaylinda. It's so good you're in. Is there a limit to how many Bitcoin can be mined? And if so, why? This might be a dumb question. So this was set up. No such thing as a dumb question, by the way. Don't ever feel intimidated by this. It's okay wherever you're coming at this from. It doesn't matter how many degrees you have. The key is, and the key to any experience in life is lifelong learning, the ability to go on, challenge yourself, as you are doing right here in this room on a Thursday evening. I'm so grateful that you're here. So in this question, there'll be 21 million Bitcoins in total. This is an artificially constructed scarcity. So in the same sense that there's scarcity for certain things, like right now we can print hypothetically infinite amounts of dollar bills if we wanted to. Bitcoin has artificially built-in scarcity. Now this works in a good way and a bad way. By reducing your supply, you increase the potential value. But on the other hand, who owns the supply becomes a really good question. And one issue that we have in cryptocurrencies are crypto whales. And you're like, I know it's like Captain Ahab, it's one of those things, the great white whale. And we think about crypto whales refer to people who own a lot of these cryptocurrencies. But unlike say, like for instance, if you're a publicly traded company in the United States, we know that publicly traded company has to file all the material information with the SEC all the time. They have to put their finances 4 times a year. I need those quarterly reports. I need those conferences. We have an idea what's going on in that company. We even know if you own more than 5% of a company, you have to declare your intentions. What are you there for? Are you going to buy it? No, I'm just here for the show. I want 5% of the company. Then those are the rules. And cryptocurrency, because of its anonymity, we do not know who the identity of these people are. It could be your next door neighbor with the 800 computers, or it could be a diabolical conglomerate in another place, like an evil lord. You have all of these things that could happen. We just don't know. Most likely we don't know. So for instance, the 11 largest Dogecoin portfolios hold 46% of the supply. And those finance people are like, this sounds a lot like Hunt Brothers and commodities and silver. Anybody who has this much of this one thing, anybody who has this much of something has a disproportionate effect on how that thing is going to move. So the 3 largest Bitcoin wallets, which is more disseminate than something like Dogecoin, have about 8% of the currency. That's a ton of money. Those are billions and billions of dollars. But we have 2 other questions. One question said, what might be some catalysts that could cause the crypto bubble to pop? That's a really good question. And that ties into this same question. So ultimately, if you have 11 portfolios that own 46% of the supply, and somebody starts cashing out, the problem is this all works together if no one sells anything. Like 46% of the supply is locked up, and as long as nobody decides to buy that yacht, we're okay. But as people decide to cash out at some price, you're in kind of this game, right? We know that if people initiate a sell, that sell becomes can go off the rails really, really quickly. And think about how we act in behavioral finance. So for instance, we know, we've actually measured this in behavioral finance, that the feeling you get from receiving, say, $20 is half as great as the feeling you feel when you lose $20, meaning that the feeling of loss is twice as great for an equivalent feeling of gain. And that's an incredibly fundamental thing for how markets work. So if people lose value, they start behaving more irrationally, and they start behaving in ways to protect their assets in a more succinct way. Now, I think in the long run, there's a few things that can cause this bubble to burst. And for instance, it could be anything from the nature of regulations on cryptocurrency to the nature of how we value, or the nature of how this technology itself naturally unfolds. And people say, we have to be really careful about deciding what's economic and fundamental value. Another question, does this mean that we can't track my gains? They can't. So this is a really good question. So here's the thing, if you're operating, that's a really good question. Somebody asked, does this mean they can't track my gains and my income taxes? I like this. We were just talking about this the other day. If we have to ask where the line is in finance, step away from the line. That's the point. So you have to ask, so can I get away with not paying taxes on this? So the IRS does treat this as an asset that you are taxed on. So your gains have to be taxed. And you have to go through, and usually, for instance, if you use brokerages, other things, you have to do this. But the regulation is lacking in this category. There is not enough institutional support from the IRS to make that happen. So this is a really good question. We have a question as well. Gold's value is largely hedonistic also. Well, how is Bitcoin different? How is Bitcoin different than gold? Gold fundamentally is a really shiny metal. It has some economic use. We can call this, but it is a fantastically shiny metal. It makes things look very gold. And I know we can make things look gold, right? I got a PhD, everybody. It makes things, what does gold do? It makes things look gold. So one of these things, oh God, yeah. Okay, good. I got a time check on this too. I gotta start flying through this. You guys are so, these are great questions. So long story short is, fundamentally, you can look at them the same way as a hedonistic question versus a fundamental question. And they're not fundamentally different in the sense, but notice that anything that we have is all based on our ability to, make, to decide that something has value. 3,000 years ago, China, India, and Africa were using cowrie shells as currency. Because that had currency and that had values, there's no intrinsic value to a cowrie shell. It's terrible. It doesn't taste very good. But ancient peoples have been using it globally as a prefect for currency. So I'd say that in that sense, there's always, it is what you say it is. So blockchain, smockchain, what is this good for? So here's the thing. Bitcoin's predominantly digital. Ethereum is a digital currency. Bitcoin has become a digital currency, I should say. But other blockchain functionality exists that I think we talk about the question of value. Ethereum is a decentralized platform that runs a lot of smart contracts. So these are applications that run without any possibility of downtime, censorship, fraud, or third-party interference. Things like this include smart debts, smart wills, smart finance. Think about the ability for making a transaction that was legally enforceable. Now, it's not currently legally enforceable. Making a transaction like a will or a debt, or making a lot of financial applications without an intermediate third party. There's private blockchain applications, which we'll get to, non-fungible tokens, which we're going to get to, and then decentralized finance. And if you've seen this on TikTok lately, there's a lot of promise around this, some of which we overhyped. This happens to be blockchain J, and blockchain J is closing the banks. Now, private blockchains, most practical institutional benefit of this. Economic value number one. Let's say we have 3 banks and 2 customers. Let's take a look at those ledgers. Aren't they just delightful? Okay, so I have Bank A and Bank B and Bank C and 2 different customers that operate in all those 3 spaces. Now imagine if we could consolidate that on a blockchain. 3 banks, 2 customers, 1 blockchain, readily encrypted and only unencryptable by people who are registered to be able to do that. That presents an institution of value. This can get rid of a lot of back office work at financial institutions. And it's worth for financial institutions to look into if you're at Thornburg or PIMCO. Applications, Internet of Things, right? So we know that Internet of Things, blockchain provides proof and security against hacking. It is not fully bulletproof. And I've had a discussion with a fantastically technical literate person, and I want to thank them for this, about ways that the encryption of blockchain can be broken. Back office efficiency, JP Morgan. Right now, JP Morgan is using or unrolling ways to include encrypted versions of all contracts, and only the parties to the contract have the ability to decrypt them. That's on a private blockchain. Prescriptions. Doctors can issue, one of the things we have is there's significant medical abuse. A doctor issues a token to a patient for a prescription that cannot be resold and has a clear expiration. The pharmacist reads that information and gives them that information. That prevents abuse. Medical records. If you changed doctors, one doctor to another doctor, you have to go through the process, which may be labyrinthian, of getting all of your medical records transferred over in a succinct way. There's been many startups along this that have tried to codify this software. Blockchain's a way to provide a private key that you can transfer between medical professionals as you move on in certain circumstances. So here's another question. Can we see? There's a good one. Daniel says educational records. He's absolutely right. Educational records. Another question, can we actually see these transactions on the blockchain? If they're public, we can, but private blockchains by their nature will be private, and that's trying to alleviate some of these things. So accountants can validate company ledgers in real time. Public maintenance deeds, titles can be valued. You can actually imagine hypothetically being connected to a blockchain where accountants could immediately verify these transactions that you were making beyond the need for quarterly statements. CNM is starting to store degrees on the blockchain. That's pretty cool. So let's talk about non-fungible tokens. I know I'm kind of rocking and rolling through this, and we'll make sure. I'll stay later if you'll stay later. It's one of those things, but I'll make sure we get through this quickly. Your time is valuable. So non-fungible tokens. Let's go back in time to 1979. Pink Floyd released The Wall, and it went to be the top-selling album in the United States in 1980. Sold over 30 million copies worldwide. Very popular album. In those days, and I looked this up to be sure, the average price of an album was $8, and ultimately was based on supply and demand, right? So if demand exceeded supply, if the record company couldn't print enough albums to meet demand, albums fly off the shelves, people start bidding on the black market for these things. Look at PlayStation 5s right now, right? PlayStation, because of the semiconductor shortage, can't manufacture enough of them. You can acquire a PlayStation 5 from a fellow in a trench coat who might offer it to you for like $1,100. But the problem is you end up paying a premium for something that exists in this way because demand exceeds supply. When supply exceeds demand, the album ends up in the discount bin at Dollar General, right? And there are many good albums in here. Basically, that's where my music collection resides. I'm like, oh yeah, Winger. All right, copies that have special value, like signed copies, command a market premium, right? Now, here's the thing. Back in 1993, MP3s were invented. And this was so fundamental to the way we look at supply and demand in music, because you could copy a song an infinite amount of times. And what is the fair price for something with an infinite supply? It's like selling molecules of air. And yeah, I know there's a finite, we could calculate how many molecules of air, but if it's like selling these things, it's like selling an infinite quantity of something. The fair price of this is $0. So one of the things about this is, okay, here's where NFTs come in. If you are an artist, or you are in music, in something as in art, in digital space, how do you get paid for your work? And again, one of the solutions that's been devised from this is the idea of a non-fungible token. And you can't spell non-fungible without fun. Something that's fungible means it's interchangeable with something else, right? It's like I can take so many things and brake pads or something. Non-fungible items are unique. NFTs have been around since about 2012. And what happens is NFTs allow artists to stamp a very specific identity around these things, and effectively a digital signature that says, this is the copy. Ethereum is the largest blockchain that issues NFTs. They can be hosted anywhere, but only sold on platforms that support similar blockchains. Bridges between blockchains do exist, though. Oh, this is a good thing, too. Great questions. I love these comments from Josh. General identity, like biometrics. Carly says, privacy and cryptocurrency, Monero, all that stuff. Oh, that's awesome. Oh, that's awesome. So as a digital artist, you can create an NFT on Ethereum pretty easily. Any wallet that supports the ERC 721 standard. And you can upload your artwork to a digital marketplace like OpenSea, Rarible, or Mintable. So I'm going to show you something. This is a screenshot of OpenSea from Monday. I won't. Catherine, I said, don't. No, Catherine, I'm not. Don't forget my tax question. I answered your tax question. Don't shirk the IRS. So no, it is hard for the IRS to track anonymous accounts right now. Regulation is coming forthwith, but you have these broker dealers. But the art part is sort of something like Robinhood, for instance. They actually own the cryptocurrency for you, and you make a representative profit on it. You actually don't buy cryptocurrency through Robinhood. They produce. You have to get a tax form from them every year on your capital gains, and similarly, brokers should be able. Any broker who deals in this should provide you with those things, I hope. But yes, it is, it is possible. This is why cryptocurrencies are used for illicit things. So anyway, so this is OpenSea. This is OpenSea from Monday. I love the question, Kevin. I love it. So this was, I sorted it by auctions of NFTs that actually have offers on them. So people are visibly actually bidding these things up. Top left, we have a bid for 30 Ether. 30 Ether. So think about this. This is what? So 30 Ether times like a little bit 2.4 thousand per Ether. So we get something in the $70,000 range for this upper left artwork. And then we have the clout monster. And then we have all this other art. And you can go all the way down because when you interact with NFTs, you can get on this and just, you can draw a picture yourself on the back of a napkin and call, you can call it CFA Society Fun and sell it there for a penny. And you can see if anybody buys it. Oh, good. Haven Protocol. Now, the NFT in your bonnet. Beeple sold an NFT for $69 million back in March. And this has been used to sell memes. The Charlie Bit My Finger NFT. That went for $761K. Grimes has sold $6 million of art as NFTs. The Disaster Girl meme, $500,000 as an NFT. And why would people buy this? For the same reason they buy other art. It possesses emotional or hedonic value. They are also betting that because of this, other people will want to buy it, and in the future it could go up and down. Already investors do invest in things like art funds. Now they aren't really well correlated with traditional bond and equity markets, which makes burgeoning NFTs an intriguing asset class, but one with significant risk. We just don't have the time frame. With traditional art markets, we know how things have appreciated over the last 150 years to a pretty good level of detail. We're looking at something that literally has hit the big time in the last year. So, talking about a practical example on this. Now, this is another way we look at value for this, and this is something called decentralized finance. So one of the things that decentralized finance does on the blockchain is you can currently take digital wallets right now that hold cryptocurrency and earn interest on your cryptocurrency. Anyone can feasibly become a lender to someone else of cryptocurrency. For borrowers, collateral requirements are usually pretty high, usually about the amount that you have to borrow. But this can be used. And these lending rates are very, very attractive, right? The interest rates you get on certain currencies vary wildly, but it might be 10%, 18%. What an interesting thing. And if it's fully collateralized, it makes a relatively safe financial transaction. And this is the number one question I've gotten in the last 6 months. Do you believe cryptocurrency will ever be adopted by the United States as a digital currency? And the short answer in this is probably not. By its nature, cryptocurrency is decentralized. And the people that own cryptocurrency, we have no idea who they are. We don't know who the 11 holders of Dogecoin are that control 46% of them. If an existing cryptocurrency starts handling a significant portion of transactions in this country, and I estimate, let's say 5 or 10% of all the transactions that take place, monetary policy at the central bank level becomes ineffective, and the state will step in and probably make it illegal if it isn't already. Now, on the other hand, what happens is the most likely outcome, Jerome Powell had a video last week. I want to thank Daniel for dropping that in my inbox. It was a great thing. The government's going to come out with ways to utilize the best features of cryptocurrency, decentralized, blockchain, things that way they can use and maximize their efficiency. But if a digital currency exists, it will be government controlled, which is not really a cryptocurrency. Cryptocurrencies are decentralized. It's an anti-sovereign concept. And this also presents something where it won't happen in the United States first because of our institutional barriers, right? For the same reason that the United States lags behind many countries in digital payment systems, we already have infrastructure that does other things. East Africa, Tanzania, Kenya, they have mobile payment systems and usage that far eclipses ours. China, similarly. And that's because we have a lot of existing infrastructure in place. For us, we have existing financial infrastructure in place. If you have a very effective financial cryptocurrency or even a gov coin that's very effective, you don't need individual banks. All lending can be done through the central bank with no intermediary. And so hypothetically, everybody can get really, really cheap loans on stuff. But the problem is we have a banking system here that it's impossible to imagine that taking place to that level in at least the short term. And now, this is the last slide, I promise. I know it's keeping this is almost there. 60, we're almost there. Rock and roll. This is the last one. So let's tie it back into some things that work here. What did we learn? So when you're betting on, let's talk a little about speculation. When you're betting on something just because other people are doing it, you're speculating. Control your thoughts into focusing on where the value lies. Okay, so if you decide cryptocurrency is valuable, which cryptocurrency and for what reasons? Fundamentally, it's unlikely that any existing cryptocurrency will become a national currency, but it will likely remain a separate asset class. It's not going away. 1 year, 5 years, 10 years from now, people will always have money. They'll always do it. The startup costs are so little. We have the infrastructure there. It's going to be a thing. It's a thing. Cryptocurrency will remain an easy way to speculate on sums of money. As Dogecoin showed, some digital assets have more hedonic than fundamental value. Blockchain applications, though, do have value. And so let's think about least risky ways you can approach something like this. Invest in blockchain as a time of transformative technology in your portfolio. Many safe companies out there are utilizing blockchains to improve their efficiency. That's an interesting sign. How are they using it? Is it hype or are they actually aggregating efficiency? How would you measure those things? Tell a story about how the business works using blockchain and how it represents a competitive advantage that brings money back to shareholders. The F in finance is for future. So how will this company generate cash? And the riskier investments. Well, widespread institutional investment might be a few years off. You notice Carl Icahn came out. Every time I give a presentation, I can't make this. I made this presentation on Monday. And I was like, no institutional investors have. And then Carl Icahn's like, well, 1.5 billion maybe in cryptocurrency. And that was an interesting move. And he's not being specific as to what and the how and the why behind that. But watch the underlying technology. Which crypto platforms utilize the most apps and have economic value? There's a private question that asks just that. What's your favorite coin or most valuable coin? I can't give you investment advice, but one of the things that you see a lot of on this would be, and this is one thing that we've been kicking around, and we mentioned that in our published papers too. For instance, Ethereum, through a decentralized application system, meaning that developers can come across with new utilization for Ethereum all the time, and new usage and protocols and things to work on and things to do. This represents a very interesting idea and also powers most of the NFT market. And so in that sense, the cryptocurrencies that are tied to things that do economic things that you understand, now that's an interesting investment. Oh, this is a good one. Oh God, this is a really good question. Another private question: how rampant are pump and dump schemes in crypto markets today? So first of all, incredibly. So, but not in the same way. This is the hard part, right? This is that fine line between somebody like, this is the interesting thing, right? So this is not a conversation about GameStop. It's not a conversation about other things, but we live in a world now where information can be transmitted so easily and so anonymously. It is very hard for federal regulators to imagine if you're dealing with a dark web site with a bunch of people in there who have a lot of buying power in cryptocurrency. It is quite possible you can develop it in a cognizant way. You can make a scheme where you say, all right, we do this and this, and no one ever finds out, who's behind it. So I think because the odds of getting caught on that are so low, it's quite prominent. And I think it's something that it's hard by its nature to regulate because of its anonymous nature. Now, government coins will be regulatable. And that's what you're going to see sovereign nation states go towards. If we use the blockchain, we're going to use it on our own terms, and we'll know who's behind all of these things, which is also double creepy, right? Oh my gosh, this is good. So yeah, Sterling's right about that. Oh my God. Oh, super fantastische. Rene. Thank you so much. Opa Bayan. Daniel, decentralized 88. Quinn, proof of stake chains tend always towards, oh, this is great. You guys are having a great conversation about ADA and Ethereum. Oh God. Carly brings up a good point. Tether. So there are some cryptocurrencies that are tethered to, say, the US dollar, as Tether is, which provides a stable amount of price. And Tether becomes interesting because, well, it's utilized in a way to provide a store of value. And when it was initiated, Tether said they had 100% backing of US currency. And they released this year what actually they own. They own a bunch of US bonds, other things that add up to about 100% of the value. But Tether is also famously called out in a paper from last year by a couple other finance and economics professors who measured it. And they found that they could use Tether as a way to manipulate cryptocurrency prices in the market. They actually made a predictive model to show that works. And this is the hard part, right? Public markets have the benefit of regulation. They have the benefit of you going in there and knowing approximately what things are. Even when you have a bad actor like Enron in the market eventually figures it out most of the time. And the hard part is for cryptocurrency, there's not a guarantee of this. So who backs Tether, or is Tether? Tether is backed by its own, I think it's Cayman Islands based series of US denominated assets. Oh my gosh. Oh, this is a great question. I like the people that have made it this far are like, all right, Reilly, this has been fun. Now talk about algorithmic stablecoins, the Anchor protocol. Is there any evidence whether algorithmic is better than fiat backed? That's a really good question. I don't know the answer to that yet. Does anyone else know the answer to that? I'll let you guys talk about that in the chat window. Oh my gosh, that's super fun. I love this. This is good. This is good. You guys are like, let's ramp it up. All right, Reilly. All right, finance person who introduced themselves as a non-technical person. Let's see how you do technically. That's good. Oh, it's getting hot in here. Questions. What else do you guys have? Yeah, there we go. Sterling. Sterling, my co-author. Sterling is the best, by the way. Sterling Olson, fantastic. So I'm so glad Sterling's here. But he is the first person who got me. You always remember the first person to get you to look at this asset class seriously. He's brilliant. We have a lot of brilliant students here. This is really good. I love that, Catherine. Thank you so much. Walter asks, is there any potential for cryptocurrencies to be used as international reserve currencies? Well, that's very tricky. So the problem is I would say that in the concept of currency, in a reserve currency sense, probably not. And this goes back to the question of how fiat actors work and how currencies end up being traded on the marketplace. Even though it's likely that basically, and I did a paper in international finance a few years back where we measured foreign exchange exposure that we have across different companies. And basically everybody has foreign exchange exposure. And we think about these things about how actors work and how currencies work and how currency dynamics work. And the thing is, each of these end up being central bank controlled currencies that are representative of an economic system. Whereas cryptocurrencies being separate from those things, being separate in its own parallel economy, don't lend itself very well into a circumstance where it can be used as a reserve currency. The fundamentals just don't work really well. So for instance, like literally, I can make the Chinese yuan a reserve currency, but I know that the Chinese government owns this, and I know how they work and I know how they operate. I don't know who the biggest owners of any cryptocurrency are. And because of that unknowable, that undermines its ability to be a truly neutral party. And similarly, you might look to countries that have suffered great financial distress, like Venezuela or Zimbabwe back in 2008, right? Zimbabwe 2008 had incredible hyperinflation. People started using the dollar and euro in the black markets to transact goods because the goods markets failed because prices were going up so quickly. And when prices go up so quickly, people spend their paychecks immediately, goods don't get delivered, supply chains break down. But the government resisted an attempt to use the dollar and euro earlier because of what it meant for national sovereignty and national control. They eventually gave in because they had no choice. But governments vacillate on this even when they're in incredibly adverse economic situations. So imagine if you're Venezuela using the Bolivar, or you're in Zimbabwe using It's the Zimbabwe dollar. Oh yes, the slides. I had a question to share the slides. I will email them to Kyle, and I guess YPA can you guys can use them whenever you want. You can print them out, light them on fire, and throw them somewhere like a waste barrel. Whatever you guys want to do with the slides, I'm perfectly good. Oh, look at this! These are like my all-star students. You got Cecilia and Catherine and Laura. Oh my God, Daniel, it's like a reunion. I'm so happy you all are here. All right. Sterling did beat you guys, Quinn. You got me on different cryptos, Quinn. That's good. You're equally special, Quinn. But Sterling said, here's where the money is. And everything, I will say this about Sterling. When we were talking about the value for cryptocurrencies and things, he was calling it, he basically broke down the market today, 3 years ago, very succinctly. So I want to give him street cred on this. Quinn did too. Quinn talked about DeFi and those things. What else you guys had? Oh, that's a good question. Oh, sorry. Uh-oh. Got rid of that there. Okay, so Carly asked, given that we have Shor's algorithm that solves the prime factorization problem in polynomial time, when quantum matures, won't blockchain technology be at risk? Ooh, great question. So one thing to boil this down, okay, great question, Carly. Quantum computing, conceptually, think of incredibly fast computers. Incredibly fast computers, could they be marshaled to break the encryption that's being created on traditional computers, for instance? There was an article in Forbes that said not really. There was an article in something else that said it could. The encryption is brilliant, but it's not foolproof necessarily. And the problem is we don't really know the answer to that yet because we haven't tested a quantum computer on it. But my optimistic hypothesis is that when we use a quantum computer and develop hopefully the next stage or whatever the next iteration of this looks like, we're going to have a opportunity to develop encryption that will be effective against quantum computers. Oh yeah, that's right, Sterling. It's a question of relativity too. Sterling, that's a really good point. And so when you think about relativity, it is more secure. It is more secure than my bank. I mean, literally, right now we have a relatively insecure system. Password compromises are easy. They can be transacted. You've all received emails in the last 6 months that said your password has been bought by somebody on the dark web for something else. And you're like, oh, fiddlesticks. Now I have to make finance number 2 instead of finance 1 my password. It's not really my password, I promise. But you have this situation, but encryption in blockchain is superior to basically all of those. Walter says there's some cryptographic algorithms, ooh, that's great, that already exist that are quantum resistant. Yes, it really depends on what kind of encryption is being used. I had another person counter me on that, Walter. I brought up that same point and the person said, well, we haven't tested them and they thought it was breakable and it does exist. So that's a good question. I don't know enough to evaluate that. Holly asks, what are the risks to the variability of cryptocurrency if more countries ban Bitcoin? For example, China. What happens if countries do this? And this will, see the other thing, if you start using Bitcoin for transactions, countries will come out and start banning it. So for instance, go back to 2018, China did this little thing where they cut off access to the cryptocurrency, a few cryptocurrency exchanges. I actually studied this in another article with Serena Baldoni, another former student. And we have that as an R&R somewhere right now. And we looked at an event study that was around this 2018 action. And we found that Bitcoin went down in value, surprisingly, and it went down more than other currencies did. Meaning at that point in 2018, markets developed very, very quickly. But at that point in 2018, China coming out and saying this had a negative effect on Bitcoin that lasted for over 2 weeks and resulted in reduced returns over a 6-month period, which is really impressive. And so it's likely that we'll see this reduced. So Gabe asks, of course, Gabriel, Gabe, new coins with a bigger hash world come about in quantum computing world, right? It's possible. I mean, that's an interesting thing. If it's a mineable currency and you're coming out, and you're the only person there with a quantum computer, and you're going like, let's turn this thing on. That'll introduce. You're bringing the. It's like you show up to I don't know what to call it. What's that, like the Subaru road rally with the monster truck. And you're just going to come in there with this thing and you're saying, let's bring up some hash rate. But the problem is that'll be also replicated. It'll probably be a thing that replicates very quickly. And it will change those dynamics drastically. I'd be really interested to see what happens. Carly says, okay, good. Sterling, public key cryptography, good. I love this discussion. Willow, good. Are IP laws catching up to NFTs like copyrights? That's a really good question. or IP laws, we're actually in the nascent stages of regulation. And one takeaway I want you to take away from this is keep an eye on all of those regulations that are coming out from the Fed in the next year or two. And the problem is we have, yeah, you're right. So the part about this, about IP and NFTs, if you have an NFT, so I have a couple of different wallets that I have access to on my phone. And when I use this and I use something like an NFT, so I had an NFT transferred to my account today because I was screwing around with them. I don't think it necessarily is valid. It's a very inexpensive one, but I have an NFT in here and I have a very specific ID that links this to my account. If I forget how to access that ID, it's orphaned. And that's a challenging part. You're right about the loss of passwords to these things, the loss of password to those accounts. That's a phenomenal issue. And that's what makes it almost scary, right? Imagine you have a password on something, but if you don't have it, it's hard to beat. You remember that fellow who passed away, unfortunately, with 100 and some million worth of cryptocurrency, and they couldn't find the passcode for it. And that's a little bit devastating. So if you're like, you have this for that'd be a great game to play with, like with your heirs, and be like, oh, I lost my password, but then you send them on like a treasure hunt, and it's buried in like a Montana forest. Apparently 10 tries. Yeah, 10 tries, Willow. You're right. 10 tries. You're right. Finance 3, Finance 4. Thank you so much. Really cool. Really cool. Carly asked, if Bitcoin has only built-in scarcity, doesn't mean that when no more can be mined, you'll have runaway deflation. No. That's a good question. Well, people hoard Bitcoins. It entirely depends upon the value. So for instance, we know there's only so many baseballs that Bob Feller signed. And I say this because I was like, that was my family heirloom from the Cincinnati Reds. And they're like, I got this baseball from Bob Feller. And I have this Bob Feller baseball. And I'm like, Bob Feller, you're like, who is Bob Feller? Like, he was really big. You're like, what is this? The question is, there are probably very few in this, but the market went down just because people don't want to use Bob Feller baseballs anymore. And it basically rubbed off because I may have actually used that in an actual baseball game. Won't people hoard Bitcoins? Possibly. But again, that value is going to be something that'll be accessed to hoard Bitcoins. You have to recognize an economic opportunity. So in some senses, that's why we watch things like economic crises. When there's an economic crisis and people need to raise money in one area for another place, they'll sell their Bitcoins, right? And when they sell their Bitcoins, it'll flood the market with Bitcoins. That'll reduce the price. And the person who does that first will reap the most profit, and then they'll pay off whatever bills they have to do. God, these are great questions. Nested NFTs. Oh, that's a really good one. So Quinn is talking about the concept of house titles sold on the blockchain with NFTs being used as certificates of authenticity. So that's really cool. And I agree that that's feasible, but the problem is the banking and commercial infrastructure isn't there yet in this country to even adopt this in a meaningful way. I think that's a hell of a great idea. Joshua says, isn't Doge an infinite coin? So aren't investors losing money by holding? Not necessarily. So again, it comes down, you can have the dollar, right? We all have dollars here. And I actually have my son gave me, my son had saved up some money to buy some Legos. And so I'm like, I'll buy them. You give me the cash. So it's like we're doing this little inside laundering thing. So I'm like, here's 5 $1 bills. And so I have these bills. And the thing is this is backed by the faith of our economic system, right? Because it's transactions. We use the dollar all the time. I mean, we can print an infinite number of dollars, but I'm still going to hold things denominated in dollars because it's what we got. And it's what's valuable. So it doesn't necessarily, Joshua, detach it from the inherent value, whether you have an infinite something or 5 of something. If you have 5 things no one wants, the fair value of that is 0. If I had an infinite number of things that people still have an appetite for, then it does still command value. That's a really good question. Legos are a good investment. Are they? I hope so. This is great. God, you guys are great. I got, these are like you guys, the diehards. You're here late. You guys are like, oh man, I got all these appointments. Oh man. So anyways, this is cool. So another good question. Carly, thanks for getting good, Carly. Carly's coming in with the wins. Sterling, there's a company that is performing collateralized loans, selling a house as an NFT using the maker. That's cool. There's using protocols this way. So you can do it. But the question is are you comfortable doing it? And is the other person receiving that comfortable? And the bank intermediary comfortable? Oh, James. That's right. Cleveland Indians. I should know that, James. I apologize. That makes sense. I did spend 10 years of my childhood in Cleveland, James. I apologize. Thank you. Thank you for the update, not Cincinnati. So we have to compare values. Thanks, James. I love it. I love it. My apologies. My bad. Should have known better than that. That's right. 8-time All-Star.
Yeah, it's like, do we have any other questions? Speak now or forever. There's another one, yeah.
I'll do Walter's. Walter's about energy. I knew that one was coming. This is good. So energy cost, right? So we measured this. This is an interesting question. So energy, where's the best place to get Bob Feller balls, James? I don't know. Big Fun in Cleveland Heights. Any question, a comment on the energy cost of crypto mining and how that affects their viability? Energy cost exists for mineable currencies in the sense that you mine it. But those are, I mean, you have that for proof of work coins. That has been used as a way to justify proof of stake coins that don't need, or coins and tokens that don't require mining behind them. So I say it's not a killer per se, but the energy costs are significant. And we accounted for that actually in the model that Sterling and I built. And that was one thing the reviewer said is like, well, how do you evaluate this, how do you evaluate something like the cost of energy with regards to this? And we accounted for it. We said, oh, this cost of energy. Individually, it's not very significant. Collectively, because so many computers are doing this, it is significant. And that's going to vary significantly. And I think it is an ultimate inhibitor to mining currencies, but currencies, again, don't have to be mined to be valuable. And so I think that as we look forward, we're going to be in a situation where we're going to be looking at the future of coins in a non-mineable sense, either because mining has become unprofitable or mining has become more obsolete. I think we have a series of technologies that can get beyond mining. So it is a problem for right now. But for instance, when Iran came out and said, we're going to limit or make it illegal to mine cryptocurrency because it's causing blackouts, they're probably mainly motivated not only just by their energy infrastructure, but also their sovereign infrastructure. When Turkey came out a few weeks ago and made some cryptocurrencies illegal, they were worried about the effect it had on the Turkish lira. And so all of these things are really fundamental, especially for developing countries. If so many people don't have faith in a native monetary system and are using a parallel system, that undermines the sovereignty of that government. And that's why they're going to make it illegal. And so I feel the bigger problem is actually the transactional use of these coins with regards to their relationship with the monetary authorities in the countries that they operate in. It's a great question. Really great question. James, where is the best place to start crypto? Oh gosh. So when you think about this, so the question is if you're thinking about making an investment in cryptocurrency, you need to set up a digital wallet. And to do that, you can go to everything from Coinbase to all these other exchanges that allow you to buy and operate cryptocurrencies. And I would start with understanding the underlying technology. I would understand how it's being used. For example, you can look at something like Ethereum and say, this is being used for NFTs and a lot of smart contracts. So I believe that represents an onus of value. I would also look beyond crypto and say, well, what other places are utilizing blockchain? What companies are utilizing them to create efficiencies? What companies have technological advantages in issuing and creating blockchain? Oh man, where does blockchain go from here? Alexander Morgan, that's a fantastic question. I love this. This is great. I'm getting questions in multiple languages, and I just love this. This is great. This is great. You should read this is wonderful. So 4.0. So blockchain is really interesting, and this is, I was just talking about this with Sterling. We were exchanging a couple of emails a little while ago. Sterling, I don't know if you want to step in and because I asked you a very similar question about how blockchain moves. You don't have to, Sterling. If you want to add a response in that commentary, I defer to Sterling on that. I think right now, the future of this is the way that we're seeing applications being utilized by the market as a whole, and in those senses, you know, we have Bitcoin, which is this, you know, look at me, I'm Bitcoin, it's the most well-known one, and then we have actual economic applications that are being processed through here, and things like Ethereum, and I think that's really interesting, and I think it's and I think you brought up wax, actually, didn't you?
Yeah, Wax is great. It's built up from
Sure.
the ground for NFT. So the question is specifically about where do we see sort of the future of cryptocurrencies when we look at, say, sort of Bitcoin kicked it all off, but now, you know, people are sort of realizing that was 1.0, and then Ethereum was the very first platform built for smart contracts, right?
Yes.
Yeah. So I think, yeah, we did have a conversation about that earlier this week about where do we see, do we see one massive blockchain, or do we see purpose-built blockchains? And I
Yeah.
think
Yeah.
I think we're going to see
That's it.
kind of both, and which is like I don't know, I don't
Well-
think it'll be one or the other, but some mix in between. I mean, I am really big on Ethereum, although I was making fun of it in the chat. There are plenty of things to make fun of Ethereum for, but it has the first mover advantage. It has
Right.
the most developers. Like if you look at, you know, GitHub commits and the number of things that are based on smart contract technology, best comparison I can come up with right now is it is going to be the Amazon, say, of the blockchain space. But I think purpose-built blockchains are going to have their place as well. I am really big on Wax, which is a clone of the EOS system, which was built from the ground up for NFTs long before this whole craze was going on. And they create very cheap, like one of the huge problems with Ethereum is obviously the gas fees. And so these purpose-built platforms have their purpose. And then Reilly mentioned earlier that there are bridges in between these blockchains. And so as long as you can move your assets from one blockchain to the next using these bridges, there's going to be use cases for purpose-built blockchains. And then there's probably going to be the big place where everything goes down, such as ETH. That's how I see it, although of course nobody knows.
Yeah, and I would extend that. I love that, Sterling. Thank you so much for stepping in. And also think of it this way. So what happens, so if I was making a practical US economic question about this, will we have one blockchain language that we use and we integrate? I would say probably not. We're gonna have these probably, if we're one thing that we're good at in this country, it's creating individual sector-based oligopolies that end up controlling various parts of this, of the blockchain. So I think finance, for instance, could have protocols and usage that's practical to their industry. I think we might see another application along the line for some other blockchain, and we might just separate this into a few large players that have control over parts of the market. And as Sterling pointed out, I think the key is these bridges to translate and operate between blockchains become really, really important in those cases. But I see that as sort of a natural progression. That's something that in unregulated market, even in regulated markets, we end up with oligopolies. So it's I view it as an evolutionary progress in that. Great questions. I love it. Fantastic questions. What did I miss? If I missed your question, you can email me or you can put it in the chat window and I'll get back to you if it's from like 18 chats ago. This has been so good. You guys have been so interactive. I've been so honored by this. This is great. I'm gonna give you all A+. It's gonna be good. We're gonna make this print out little certificates. Everybody but Kyle. It's gonna be great. Quinn, how do you feel about the legality of wash sales? Ooh. So, oh man, I have mixed. So in a wash sale in finance, you buy something and then you sell it at a loss and then you reacquire it later on. So the absolute free marketist in me likes the legality of it because I think that's fine and it is legal. And I think there's nothing intrinsically wrong with it other than it builds volatility. Do I think it should be limited? Maybe. Yeah, that's good, Carly. Thanks, Carly. Quinn says, oh yes, this is a good question. So I'm gonna get that one. So I think that, all right, so here's a long story. When you build something like wash sale rules in there, it can get really messy really quickly. Right now, one of the, so to enforce that in a regulatory standpoint, it would be enforced at the broker level. So the person handling the trade, so a Coinbase type agency would have to have a lot. So if the US comes out with these regulations and rules, Coinbase would say, well, you know, if they made it illegal to do things like wash sales what you would have to do is they'd have to go out and enforce this in a mechanism that makes sense. And it's very technically possible and feasible, but I'm so grateful. Danke so much, Renee Zupa, about it being legal, because it is indeed liquidity. Oh, this is so many questions. Okay, so hold on. So I think with regard to wash sales, I think it makes sense to keep it in there for now, because it does add to potential volatility. But again, you're not effectively eliminating speculation that way. I understand also the desire to make it a more mature market and say, well, we want institutional investors in here making this space. Institutional investors won't approach this stuff until the volatility comes down. Right now, the volatility, if we look at some levels, it's like double what we expect for stock markets or common equities. And so then it's just a lot of stuff. And so it's something to really, it's very hard to, even with these returns, to stomach if you're an institutional investor or an asset investor. It's just so very, very hard. And because there's so many unknowns that are out of your control, whereas having information is something you can control. Sterling asks, is DeFi delivering the promise of fintech? Like, just the mere aspect of what we see at JP Morgan about integrating a blockchain to create simplicity and get rid of back office operations, I think that's a heck of a great thing. I would say that that's going to continue to make these operations more efficient. And so Quinn says, where you can sell at a loss, claim it as a loss, then jump back in within 30 days. Yeah. That's right. We talked about that. Good. Carl, I'm holding it in A+. Good. It is legal. No, it's legal. Joking about illegal. Good. Let's make this last question. Let's do questions. Let's make this the last question so we can do closing announcements. Okay.
Thanks for that, Reilly.
Thank you so much. No, I like that. Thank you so much for Kyle. Sorry, that was a random message. People, they just want to leave. Quinn says, do you think the growing amount of corporate investors will be investing because of enticements and potential tax offsets to these wash sales? I do not. I don't think that's enough in itself, ipso facto, to make corporate America to say cryptos are things we want to hold. I think it will be an intriguing investment. And I think once big money starts playing this out, they're going to be looking at the fundamentals in this and saying, okay, how are the decentralized apps working? We're going to be flooded with a lot more information and a lot more ways to process this. And I think that institutional investors and corporate investors will have a role in this space. And I think they're going to expand it, but it won't just be for tax treatment. I think they're going to be looking at potential investments, investment purposes. I think people who ignored it for years are coming online and saying, no, it has economic value. They're going to sort out that economic value. And I think, on the other hand, companies will be more proactive about indicating that they are making investments in things like blockchain technologies because they view it as a net good for efficiency purposes. So I think that's going to be dictating a lot more of this. That'll be good. When Lampo. This is really good. All right, I like it. So thank you. Thank you for your patience, YPA. I turn it back over to you. Thank you, guys. I will.
Yeah, and I think, Reilly, if you want to post your email address again in the chat, I know it was on the last slide, but I would encourage everybody to continue this conversation going. And obviously, Reilly's very jazzed about it, so I'm sure he would welcome any other questions. But Reilly, just want to give you a huge thank you, and for those of us that are on camera, we can physically give you a round of applause, but we really appreciate you taking some time out of your day to come and talking through this information with us. So Reilly, thank you. For everybody else, we have a couple great YPA events coming up over the next couple of months. We're doing a grant giveaway where our members will decide where $12,000 worth of grants go, and we're planning an event next month at Top Golf. So be on the lookout for those. Be on the lookout for the June Lunch with Leaders. And Reilly White, thank you again. CFA Society of New Mexico, thank you for teaming up with this event. And I hope everyone has a great night.
Thank you all. You all are wonderful. What a fantastic audience. You guys rocked. Fantastic questions. Stay in touch. And thank you so much. Thank you so much for my international contingents all around the world today. I'm so grateful. Have a great night, guys.
Thanks, Reilly. Bye.